are live. Okay, so let me go to my profile. Oh yeah, here we go, live. 1 second. Okay, perfect. Okay, guys. Well, welcome to the channel, and I have with me Sina, or online you're Sinz, S-I-N-Z. And you know, your background's very impressive. You have a PhD. You went postdoc work at MIT. You work in big data for a Fortune 500 company, so you know how to analyze data. And I think there's a lot. That's a skill that you don't see a lot in Bitcoin at all. So I'm very interested in kind of your, you know, your insights as to, as a data scientist, what you see in all this mess of ETF flows and Bitcoin prices and you know, market values versus realized prices and all that stuff. So we're gonna go in. I'm just gonna try to ask semi-intelligent questions. I'm gonna let you do the presenting, but just go slow. That's the only thing I ask. So why don't you start and kind of introduce yourself a little bit more, and then kind of make sure you can upload the deck. I think you can, but
yeah, we'll figure it out.
We'll figure it out.
Hi everyone. Thanks a lot for inviting me, Fred.
Okay.
My name is Sina.
Okay.
Someone is mentioning John Cena, like the wrestler. That's exactly how I tell people that, you know, how I tell people that pronunciation. So
okay.
If you like wrestling, lots of people know him. Slightly better physique and everything, but that's how it's pronounced. I am a professor of business and a very passionate Bitcoiner. I spend most of my time doing research on businesses and companies, and a lot of it is data analytics and econometrics. And I try to bring some of that to the Bitcoin space. What else? This year we made a major move, kind of brought together several of my friends who were all experts in Bitcoin. We established a company called 21st Capital, right now doing consulting. And what else? My background is in engineering.
What part of the world do you live in?
East Coast.
East Coast. Okay.
So
cool.
yeah, well, I think we're 3 hours apart, right? You're in San Francisco?
Los Angeles, but yeah.
Los Angeles. Okay.
Yeah, okay.
Yeah. So yeah, did my bachelor's in engineering and a master's in IT, and that's where I got some cryptography basics. Then came to the US, did my PhD in business at Arizona State, then moved on to MIT for a postdoc, and also worked for about a year in San Francisco, doing mostly data science and designing delivery systems. Yeah, it's been a few years that I am running a Bitcoin education platform. It's called BitGuide, just making educational videos about money, economics, security, about Bitcoin. And then, as I said, this year we've expanded our work to make it a bit more serious. I love working with data. That's what I spend. You know, I probably spend 7 hours a day analyzing data.
Wow.
And that's what I think can be helpful in revealing some things about the Bitcoin market.
Okay, great, fantastic. Let's use the deck as the
all right.
So
what do I need to do? I see the share screen thing.
Try that.
And what is the add resource? Add a presentation. Let's try this one. I'll upload my slides.
Either that or just try the screen share, which is also, you can put them in a tab on Chrome or something. I've done that before, but I've never done the presentation. It might work.
Okay, presenter overlay. Unable to share the screen. I usually like ramp up all the features, and that creates a problem when we want to share things.
Seen show the show on screen. Okay, great.
What do you see?
I see your screen right now.
All right.
And I don't see you anymore. I sort of just see the screen, but it's good. I mean, except the screen is kind of going infinite. Yeah.
Well, you
Beautiful.
should see my slides.
Still not. Click drag to move. No.
All right. Apparently, share screen, share window, present overlay. Okay, it's a small overlay, and then select the window. I get error. So let me try uploading my file here. That's probably easier.
Okay.
It's already here, so I click on present.
Oh, that looks very promising.
Okay.
There we go.
Okay,
Beautiful.
we have three screens here. Okay, so
Great.
let's see. I have some things. So today we will probably talk quite a bit about the ETFs. I'll present some of the analysis I have. Some of it is descriptive. Some of it is modeling the effect of ETFs. Then I have a little bit of a bonus about some work I've done recently on on-chain indicators. And then I have a surprise for you, Fred, especially. If we have time, we'll take a look at that.
Okay.
Yeah, I'll leave it for the end. So let me begin. We talked about me quite enough, so I'll move on.
Good. Let's move on to the star of the show, Bitcoin.
Yes. Well, we just wrapped up one full quarter in Bitcoin ETFs, and what a quarter it was. Very, very amazing. Lots of surprises for a lot of analysts that were skeptical. And
where were you, just out of curiosity, before this thing started? Were you pretty bullish on these ETFs?
Oh, yeah. I mean, sort of about 8 months before that, we've been covering every development in ETFs in my own channel. When this thing was just a speculation, we were talking about what it could mean. Month after month, this got more and more serious. I'm personally a very skeptical person, but every month a new piece of data comes in and you just get more and more confident in it. And most of the time, we try to battle the people who just randomly, making backhanded comments. Oh, this is gonna centralize the whole thing and break the market, and people are gonna short the hell out of the market, and they're gonna create. So
the thing I heard a lot from my kind of, crypto crowd, the people that I knew and followed, was ETFs are useless because self-custody is the future. We have to self-custody. We can't have BlackRock hold your coins, or Coinbase in this case, right? And they were very, very skeptical about whether it even was going to take off, because they were like, we've seen this before. Bitcoin futures crashed the market when it came out, So there's a lot of skepticism, I think, from the pure Bitcoin community.
Yeah, and kind of a cognitive bias that a lot of people commit is they look at the last time a similar thing happened and sort of say, okay, this time the same thing's going to happen, without really, examining what could be different. So I thought, I'll begin with some cookies from Larry. Reviewing what journey he has gone through. Famously in 2017, he said, Bitcoin is the index of money laundering, right? He probably regrets saying that, but he was very much against it. In 2021, a lot of us were, speculating when this and that company is going to come in and add Bitcoin on their balance sheet. He comes out and says, we won't do anything about it until it's legitimate, kind of throwing some cold water on the whole idea.
Right.
In the same year, it is revealed that BlackRock makes a lot of money in mining and trading futures. So apparently, he begins thinking maybe we can make some money here without really making too much noise about it. a year later in 2022, we hear that they are now managing a good portion of Circle's reserves, and they launch a spot, a Bitcoin private trust for their clients, the wealth management clients. They also debut a metaverse ETF, which I had no interest in, and I'm not sure how it's doing, but
Right.
metaverse probably, I guess, has under-delivered.
It's under-delivered, but it's kind of coming back right now. You know what I mean? Like if you look at, like the Apple Vision Pro and everything like that, you know what I mean? So
Yeah.
I kind of feel like Zuckerberg looked like an idiot 3 years ago when he changed the name of Facebook to Meta. But I'm sort of inclined to think he kind of now is, he obviously has better data than you or me, speaking of data. So he has access to all the data and we don't, so.
Yeah, we'll see what comes out of it. There's a lot of potential, in creating virtual worlds, but we'll see what comes
Have you tried the Apple Vision Pro personally?
No, not yet. No.
Okay.
It kind of kills the moment. The ad they had was not so exciting. The idea was that you can wear that thing and record your family's important moments just to miss the actual moment. So I wasn't really.
Well, I will tell you, Sina, when you try it, it's sort of like you've just opened your eyes or something. It's just, it is, you've seen the future of the world, that this is the world we're going to be living in. It's not perfect, but it's so crazily good that, it's just, it's like you see the future immediately with this thing. So I think it's incredibly impressive, and I'm definitely buying one.
The potential is unlimited. In my class, I have a project about VR and how it might impact business. And, we talk a lot about how, for example, in future, you can have, revolutionize service work with these goggles. When you're repairing a car, for example, you could see a 3D visual of the different parts and move it around, see what kind of screws you got to mess with. It's huge. Yes, totally.
It's huge. Okay, so BlackRock has been making some moves. I know BlackRock funds own a significant part of the miners, right? So they're sort of a top 2 or 3 shareholder in every one of the largest miners, right? So whether it's Marathon or Riot, or you look at the cap table, they're up there. But how much of that is BlackRock sort of taking an active role in buying a share versus they just own iShares that own public companies and therefore they own the miners as well?
No, I think quite a bit of it is active. They own
so active. So they're making an active push into owning miners.
Yes.
Okay. Very interesting.
So this this comment was very big because this is the first time in 2023 July when he changed his tune and said Bitcoin could actually revolutionize finance, and he came out really big with this. Sort of came full Bitcoin bro. It was saying, oh, this can actually be an alternative when you don't trust your government, and that kind of was a very surprising comment. Following the market reaction, this is where we had a lot of pain in early 2023. Sorry, in late 2022, the bear market. Every few months the price was making another dip, and we were just following what's happening with big guys and the ETF. And late 2022, BlackRock first announced the private Bitcoin trust, which kind of solidifies their change of position. And the really big thing was in 2023 June, where they filed for the ETF, and that was a significant signal of intent. Then a couple months later, Grayscale won the court battle against the SEC. A couple months later, BlackRock's ETF ticker appeared on DTCC website. And that was, I think, the moment where everyone realized this thing is happening. And you can see the effect on price. Essentially, a lot of these events mark the bottoms or local bottoms in price. And to my mind, based on what I've been seeing, there wasn't anything major happening in the market throughout the bear market that would have been responsible for the rise of the price. Essentially, I think what took us out of the bear market and moved us from 25 to 70 was all of that was the ETF. I mean, that's such an interesting development.
Totally.
Now, moving on. Yes, 1 quarter is passed now since it was approved in January 11th, a Thursday. We have accumulated $12 billion, which has, I remember watching one of your videos where you said there is no scenario in which this thing is not a raging success. And that was exactly true. A lot of people were just following the first few days of weak action and the price was dumping. And they quickly, concluded that this thing is a flop and it's not going to do well. And we spend a lot of time sort of explaining how big this event is. Don't look at the first few days of negative price action. As Larry Fink has said, this was the best ETF in the history, the best ETF launch.
So not just a little bit better. It was the best ever.
By a wide margin.
By a wide margin.
So very funny to see people like Jim Bianco or Peter Schiff saying this is not important. This is a bad thing.
Which is amazing to me that Bianco would say that, of all people, to me. You know what I mean? Because I would have thought he would have known better. And so I sort of question why he would do that. I know he has his own ETF and everything, but
it's probably less than a year that he removed the .eth thing from his account. So I don't think it's really partial, but who knows?
Okay, let's keep on going. Okay, so now we had that initial period, then it's just off to the races. Then we had a slowdown, right?
Yeah.
So it's sort of flat, up, flat.
Exactly. So we had some kind of off and on periods. Here I'm just looking at the totals again to just give us a perspective. BlackRock has brought in $14.5 billion. GBTC has lost $15 billion. Overall, $12 billion attracted. Fidelity is half BlackRock. The rest, we only have ARK and Bitwise that are kind of mid-size, and everything else is just very small. Average, just keep that number in mind. On average, we get 200 million. We have gotten 200 million a day, which is, again, just unbelievable.
Unbelievable.
Something that could be interesting. I thought we have enough data to look at weekday patterns. And it seems like, for some reason, Tuesday is the most bullish day. Previously, it was Monday, but with the new data, it turned to Tuesday. A lot of people, there's a lot of positive flow on Tuesday, and it gets worse and worse as we get close to the end of the week. So we'll see what happens today, and maybe that will confirm this pattern.
There's a lot of discussion on Twitter about, sort of the weekend effects, right? So everybody's sort of saying, oh, there's, these funds came in and now they've got the whole weekend, and, but there's definitely a lot of discussion around this weekend, how the weekend plays. So I would have thought Monday would have been the bigger day.
It was until a few days ago. And this could still be a peculiarity of something that have happened in the last few weeks, but you are totally right. Monday.
But it definitely feels like Friday has always been the weakest.
Yeah. So interesting. Okay. So you shouldn't really expect, if you see a weak Friday, it's probably par for the course.
This is great. This is great information, I think, for people watching.
All right.
To see this actual data is great.
Are you seeing the bad graph here?
Yeah.
Okay, so you don't have lines.
Well, no. But we have something. Just so you can just talk us through it. What is this?
Let's see if I can upload a screenshot instead. Because there's a lot of information there that just there's no way I can.
Oh, yeah.
And then you see my screen? Yes.
Yeah.
Okay, so if you see it, I can just switch. You see my slides?
Yep, we can see your slides.
What about now? The full screen?
Yeah, I see the full screen. Perfect.
All right. So I guess we just don't have our images, but I'll use this
Okay.
for the slides that are not working.
Perfect.
Okay, so what is this? Again, I was listening to people saying, "Oh, most of the inflow to Bitcoin, to the ETFs, is just rotation from other funds." So I was interested in seeing if there's any substitution effects going on. And on this chart, the red curve shows the GBTC flow, the blue shows BlackRock, and the orange shows everything except GBTC, just the collective behavior of the ETFs. You can see there's a pretty good inverse correlation between GBTC and BlackRock, and to some extent with the rest of the ETFs. Essentially, it says a day where GBTC is losing a lot, BlackRock is gaining a lot.
Yeah.
So that is some indication that some substitution is going on, as a lot of us have been thinking. And when you actually look at the progress of Grayscale and BlackRock, it's astounding how well they are tracking each other. BlackRock fell behind in the beginning, but caught up, and they are sort of moving neck and neck. So for every dollar that GBTC has lost, BlackRock has gained the same amount. People go as far as making a theory that there was a deal or something, but it's very interesting to see that in the data. Now, do you see this price chart?
Yeah.
Very well. Okay. Here, the very interesting thing about this is, again, following up on the question of substitution and whether the money is new or just rotation money. I was interested to see if there is any price correlation.
Okay.
So, for example, if all that money that goes to ETFs is just people selling MicroStrategy and miners and other things, or maybe other futures, right?
Okay.
They may have a muted effect on the price. But if ETF flows lead to spot price rise or drop, then that probably means it's new money.
Okay.
So I looked at a chart, scatter, that plots flows against price. And here, just to get rid of some of the noise, I'm using the 3-day moving average, and you can see a very good, very nice and beautiful correlation between ETF flows and the market. So what you see is the percent change in price in the colored curve. So green green part of the line means positive, negative is colored red,
right?
And the black line is flows. So you can see clearly that when flows are strong, market moves up. When flows are weak, market moves down. And another interesting finding is, remember, people were talking about the T+1 or T+2 effect, where TradFi is very slow. When you buy the ETF, the operator, the partner would have to wait until the next day to buy the coins, right? Turns out that these guys are not idiots. They somehow hedge it in the futures or somewhere else, so that they are not surprised next day when the price changes. So the effect of ETF buying appears the same day, right?
So what about when the market dropped about 3 weeks ago, right? And we had the sort of the flows become negative. Well, he will be back, I'm sure. Let's see. Let me just check on my Twitter here. Okay, coming back.
I clicked on the wrong thing. I'm sorry.
Okay, yeah. So what I wanted to ask you, Sina, is when the market dropped, I'm bad with time, but it was 2 weeks ago or 3 weeks ago. Remember when it was going up steadily, and then we hit that bump, right? And the market dropped about 10% in one day.
Right.
I have my theories as to why it dropped, but I don't think it was connected at all with ETFs. I think that was the market driving the ETFs, right? So, the correlation can work in both ways, right? So I definitely think when we're in sort of a moving up mode, you have the ETF flows. Everybody's like, what are the ETF flows for today? Like Alessandro posting, what are the ETF flows, right? But then when the market's making a move, the ETF suddenly kind of they get cautious, right? And we have very low flows. So how much of this goes the other way? How much of the correlation is, could go the other way?
So first of all, that's exactly my observation. Someone's saying my mic is weak, so I'll try to adjust it. So that's exactly my observation too.
Okay.
The day that we dropped that much, I remember it wasn't accompanied by ETF action. So apparently it was something else outside of the ETF market, like you mentioned.
Well, it was clear there was an old holder, who moved some very old coins, right, online. Well, yeah,
Totally.
No, not, it's known, it's public, so it's like $1
And then
billion. $1 billion was moved in one day, like from a 2010 wallet. So.
And did people track it to an exchange, right? So that's pretty good indication that it's moved to be sold.
Yep.
And then this is actually very helpful because the analysis that I presented so far is correlational. And essentially, we have moved on from this kind of analysis for many years. If you submit something like this to a good journal, it's directly into the trash. So what people are mostly interested in is about causation. And when you want to do a causal analysis, you're looking for these external interferences in the market that something from outside brings in and kind of nudges your metrics and variables in a way that you can now deduct causality from. This is a great one. Somebody decided to move a lot of coins, and a few days later, you do see that. The first day the market drops, and a few days later, you do see that ETF inflow significantly slows down. So we did have a big dip before this, and that was when a lot of the coins were scooped up by BlackRock. So initially, we were thinking, these guys are really dip buyers, right? But then after that big one, I think this was a wake-up call for a lot of TradFi people that was really enjoying the ride so far.
Right.
But then, this really had a psychological impact. For a few days, they were not buying. So you can exactly see as the price goes down, flows go down too. So this is a two-way causation, right?
Okay.
So price causes flows, flows cause price effects. What we're talking about right now is the combination of both of these. It's basically a correlation. And it should be interpreted as not the pure effect of ETFs, but rather, ETF movement having some information that is really good for predicting prices.
Right. Now, look, I just want to clarify that, because I've asked James from Bloomberg and, look, if we don't know, I don't think there's any data scientist or any analyst who knows exactly how much substitution there is, right? We're making sort of educated guesses here, right, as to how much GBTC was moved into BlackRock. But I'm all for back of the envelope educated guesses. So I'm curious if you had to make an educated guess of the, we went from 600,000 coins on Grayscale to, 300,000 coins. How many of those coins ended up in BlackRock versus how many of them were sold of those 300,000 coins? What would you guess?
Later, I have a slide that will help.
Oh, great. Perfect.
My guess is somewhere from 130 million to 150 million dollars a day is rotation. Anything above that is price positive. So I'll tell you why I think that.
Okay.
Let's see if I messed up with this thing enough, and if
try it again. And we got, by the way, we have about 1,600 people watching us right now. Just so we got a pretty good crowd.
Oh, that's wonderful.
Yeah.
Thank you guys for.
Thanks for tuning in, guys. And there's some questions. I'm sort of looking at the questions real quickly. People are interested in the halvening, or the halving. So we want to make sure to cover that. We're going to definitely cover the halving.
All right. So I have my source activated. Why can't I see it? Okay, very well.
There you go.
Nice. Okay, so we were talking about the price correlation. This is good, but then I thought, my eyes tell me there's a correlation. What if we analyze it more rigorously through a regression model? Look at the right part of the screen. I ran a regression between price change percentage and net flow. And I tried many other variables. I tried individual ETFs, GBTC, everything else, BlackRock. The best one is actually net flow. So that thing is essentially capturing most of the important information. You get the coefficients and everything. If you look at the bottom picture, this is how well the regression line tracks the
This one here?
price
Yeah.
movement.
Yeah.
Yeah, so it's pretty good. You don't see this beautiful correlation in regular research. I'm always amazed looking at Bitcoin models. It curiously is amenable to analysis. So that's
Right.
very interesting. On the left, you see so if you take this model and try to predict prices based on ETF flows, you get the left picture where you have the real price change day by day, and then the red line is the fitted value from the model. Pretty good. And this is what's the R square is 50%. So half of the variance in the price change is modeled through the net flow of the ETF. Think about it.
Which is pretty impressive, actually, right?
Yes.
Which is also sort of like, a lot of people say, how could the ETF be driving? But it is really the ETF flows right now. They're driving at least half of the price action, right? We know that.
Mind-boggling.
Right?
Absolutely. Because, think about all the other things that go in a market. We have a single variable here that is so predictive and so indicative.
Right. Yeah.
Like I said, this is probably not the pure effect of ETFs. It's basically, ETF flows giving us a window towards the overall behavior of the market. So a day where we have big flows, other investors and other people are also more active. So that's why you get such a strong correlation. Now, if I just take the line that I used and I put it in here to analyze the equation a little bit better, so you can see that price change equals negative 1.3 plus 0.01 times flows. Essentially, you begin from negative 1%, and then every $1 million adds 0.01 to your equation. Essentially, so to just interpret all of that, you can say that, for example, if you have a day with $0 of flow, then that implies negative 1.3% price movements in the market.
We're like a heroin addict that needs if we get zero, we drop by 1%. We need our fix.
Just think about it.
And our fix is 130 million. We just need that to stay alive at this point.
Absolutely. You got it exactly as I understand this. Essentially, a day where there's no ETF flow, that's a bad day. It's not a neutral day, right? It means something is going wrong. A lot of people are selling, so that's why zero.
Well, it's also predictive, right? Because if I see that, I'm starting to think, okay, is this over? I mean, this was sort of the picture that the Bloomberg guys were painting initially before this thing was started, that we would have 2 good months and then it would sort of dribble off, right? Yeah. And so I think everybody's a little worried that maybe we're going to see that, right? Maybe we just had this 3 months of great, I don't believe that for a second, but I think that there's some feeling that might happen, right? So if I see zero for too long, I'm starting to worry, right?
But also, it wouldn't be so unexpected. Most ETFs would have a big inflow in the first few days, a couple of weeks, and then slow down, stabilize. Like we are pretty much spoiled by the numbers we've seen, right? So these are unheard of. And then if we have $130 million of positive flow one day, that implies zero change. So that tells me that up to 130 is just a wash. It's probably money that's coming from somewhere else. People are also selling, that probably implies
that's kind of where you get your grayscale. 130 coming out of there's almost like 130 is just kind of moving out of grayscale every single day.
Yeah,
really,
it's rotating into. So that's price neutral.
Right.
And then
it may also be rotating out of miners. It may be rotating out of futures. It may be rotating out of MSTR. We don't know, right?
Yeah, and that's exactly what I expect, because ETFs are better vehicles, cheaper, right? So you expect a constant flow of money from the previous vehicles for Bitcoin exposure to the new ones. Something else that you may want to look at is the net. We talked about the average flow of about 200 million a day, right? That implies 0.88%. So kind of about 1% for every $230 million or so.
Yeah, that's kind of the number that I stuck out, and I was like, okay. That's a good number to kind of wrap my head around, right? But
Yeah.
then what about we're working on a 5-day trading, right? So on the weekends, it doesn't matter, right? So we just sort of assume that nothing matters on the weekend, but on a weekday, you have to get at least 130. Otherwise, you're going down.
Well, we have combined the way this is analyzed. The weekend effect will be sort of combined into the rest of the data because
Okay. Yeah.
on Monday we measure the change from Friday, right? So it's
Makes
kind of
sense.
mixed in,
Yeah.
So that's this one, which I thought would be really cool. And this tells me, first of all, the money that comes into the ETFs is new money. It has real correlation with the market. So all the people that were saying this is all rotation, doesn't matter, that's not right. There is some rotation, but it's not the whole story. And then you can expect the same day effects given.
So just to back down to one thing, how much is the average since January 11th? What's the average flow per day? Like how much are we getting net? Is it 250 total?
218 million a day.
280 or 18?
18. That's exactly what I on.
Okay, right. So you have 218, and of that, 130 is just a wash, right? So we're really looking at, 70 plus. We're looking at almost 90 million a day. Well, let's call it 100, right?
Mm-hmm.
We have $100 million a day of new money that's going into the ETFs, really, right? And the other 130 is just kind of, is a wash. So we have order of magnitude, we're seeing 100 million a day of new money coming in, right?
Yes. And then you can translate this into the multiplier analysis that Bank of America has done. That's a whole new rabbit hole. We can get into it if you want, but
let's just spend just 2 seconds on there. So 100 million a day coming in, right? If that's true new money, right? And it's, using something like a 50 multiplier, right? 100 million at 50, that should be a $5 billion market cap, right? Which is, off of a $1 trillion, that should be a 0.3%. So you're getting more than that. You're getting a little bit more than that in terms of new money. You're kind of closer to 100 multiplier, really, right? Than a 50.
Yes and no. I would say that, again, this gets me to the discussion of causation versus correlation, right? Here, I'm not talking about the unique, exact effect of the ETFs. This is essentially ETFs plus everything else that it proxies. Right now, I think ETF action is proxying the whole market's action, right? So if that's the case, then we can't purely look at the.
But overall, your number is sort of like if we do another quarter like the one we just had, we would expect, somewhere just under 1% a day for every weekday. So let's call it 4% a week, right? In growth, right? That's kind of what we're looking at. So, 20% a month in growth, something like that, right? Is that ballpark about right?
Yeah, I mean, look at the last line, every billion, somewhere close to 9%, right? So, and that's very, very plausible. I expect these 10 ETFs to keep attracting money well into the end of the year, and we're just gonna keep accumulating. And the rate has not, has slowed down a little bit, but still it's substantial. So we are only 3 months in.
Right. Great. Very interesting.
All right. So that wraps up this part.
Okay.
Next part is about a different analysis, about an Onchain modeling. But I'll stop here to see if there's anything else we wanted to cover with ETFs before we move on. Anything that?
No, that's good. I think the ETF story is look, we've had I just want to summarize, just kind of take your take on this. We have GBTC that lost half of its coins in 3 months, right? And if you had to guess, where will GBTC be in another 3 months? Will it have like 150,000 Bitcoin left? Something like that? Will it have switched? Will we have swapped places with BlackRock? Now BlackRock's going to have 400,000 coins and GBTC is going to have 200,000 coins, something like that.
So I'd say, in 3 months they've lost half. In another 3 months, they'll probably lose half of what's left. So they'll be down to 20, 25%.
Right.
So that's about 150,000, right?
Okay. Yeah.
Yeah, and BlackRock could very well overtake them.
So, okay.
But it's crazy, what they do is self-destruction. I can't find much logic in what they're doing. They're intentionally putting themselves at a disadvantage with that exorbitant fee, just hoping that people would be lazy enough, right? So at some point they will be either fired or change the fee.
Right. Okay. Okay. So you expect generally more of the same for the next 3 months, right? That's generally what you expect.
Slower, but kind of stabilizing.
Right. Okay.
And also notice there are a lot of firms that might want to play in this market, but they're just stuck in regulatory considerations and due diligence with the lawyers and the bureaucracy, right? And that's 3 months is nothing for them. So we should get an inflow of new players for the next couple quarters at least.
Well, what about all the RIAs and the advisors who really are still studying this stuff. They're still interviewing with the different ETF providers that they can even get comfortable with the custody, get comfortable with the accounting and all the rest, right? So it feels like we haven't really even seen, this party's just getting started.
Yeah, 200 meetings need to be done, lots of paperwork needs to be, lots of disclaimers and training, and everybody has to be on board, and this all takes a long time. So essentially, was it Matt Hogan?
Yeah.
He was basically saying that there's a lot of other entities, institutions, advisors, pension funds. They are just doing their work, and they're still not done to enter the market. So there's going to be a lot of interesting things that are still left. We just finished the initial burst, and then we're ready to get into it.
Well, one of the good things about all this stuff is this money is sort of slow to get in, but it'll also be slow to get out, right? This is sticky money for the most part, right? I think, and this is where I disagree with Bianco, who's saying it's just all these like momentum traders and stuff. I don't think, and maybe you've seen some of this, but I don't see any evidence that there's all this selling, that there's ever been any selling from these ETFs. The ETFs just seem to be going in one direction. Like
I mean, they have done this, since the first days of ETFs. It just opens up a constant bid in a market where people are generally more disciplined. People ask the advisor first before making a move. It's very different from the average crypto bro that's gets a 50x leverage in the futures market. I'm not saying they're necessarily too sophisticated, but much better than the average trader. And then they have some discipline, and they will do balancing. If they're too much up, probably advisors would tell them that, hey, sell a little bit, balance it out. If the
do you think GBTC is going to, there's a question about GBTC, couple of questions. So do you think GBTC is going to lower their fees? I know that they have this new BTC ETF, sort of a sister ETF now that they're filing to do, but do you think that they're actually going to lower their fees to stay in the mix, or do you think they're just kind of commit harakiri here? Is that how do you see it playing?
I mean, that mini ETF is helping a little bit offer. It's just a gimmick, they're not doing the real thing, and they're just offering a little bit of a cookie to the investors to keep them in, but that hasn't done anything and probably won't. If you lose half of your fund in 3 months, I would say that's a crisis, right? So you lose another half, lose another 50% in the next couple of months, and that's a big motivation to change things. I think
Right.
the only logic I can think of for them keeping the fees high is probably they thought a lot of the outflows would happen anyways because there was mostly bankruptcy, right? But as soon as they really, their data shows that it's everybody that's leaving, I think the only reasonable solution would be to make yourself more competitive or die,
Right.
I don't think they'd want to die. So
No, nobody likes to die. Okay, let's go on to on-chain modeling. Great analysis of the ETF. And just as always, your Twitter is just it's one of the first on my list for what happened today. And there's a bunch of people who do a good job. I'm not saying you're the only guy, but I love your analysis. So I would recommend everybody check out Sina's feed and subscribe to it if you want to get the your daily dose of ETFs and other stuff. But let's move on to the on-chain modeling.
All right, what we're doing here? I have a side project that a while ago I realized that there is a lot of good information in the futures market and on-chain data for predicting price. I mean, this is not new. A lot of people are talking about it, but there isn't a ton of rigorous analysis of how well can we actually use these metrics to understand what's going on in the market, right?
Okay.
And there are lots of analysis are just basically a scatter plot where they say, oh, every time this happened, the other thing happened, and you're not convinced with it, right? So I began looking at things from an econometrics perspective. Okay. Here I'm offering one example just to maybe pique people's interest, and it's a pretty good example. It's a very good indicator that also has a very nice interpretation and logic. We're not just trying to correlate two variables. We just want to also, use a variable that has a real meaning, right? So I'm using an on-chain metric called MVRV. Are people familiar with that?
I would assume not. Okay. So why don't you define exactly every one of those terms? Perfect.
All right. So how is market cap computed? You basically multiply the last price, by the number of coins that are in circulation, right? That makes sense, but it has a big problem. Maybe the last price was not the price that applies to all the coins. So let's say all the coins were sold very cheap, and there's just this last coin that was sold at $1 million, right? In the computation of market cap, what we do is we take that last number, which is $1 million, and think that is what all the coins are worth. So multiply $1 million by the number of coins, and we get a huge market cap. So what happens next is not all those coins are actually worth $1 million. When you try to sell them, you will not find that many buyers, right? There's only one buyer that wanted to pay that much, right? So when the market equalizes and everybody wants to go to the market to sell their coins, though that crazy mismatch that the market cap made us believe in goes away, and kind of the price comes back down to more normal, acceptable price, which most participants are willing to trade with. Okay, so that opens up the possibility to improve our market cap calculations based on on-chain data, which is a beautiful thing. We can't do this in any other market, frankly. Because of the transparency of the blockchain, we can compute the accurate and fair, if that's the right word, market cap for any coin. So if you look at the price at which every coin was last traded, and then add them all up, you get something called realized cap. It's it's different from market cap. It doesn't have that bias or deviation. So realized cap is typically lower, most of like 95% of the time lower than market cap, essentially telling that the market is not, market could be thin and not so deep. When the market is very, very thin, or maybe shallow, what's the opposite of deep market? Whatever, right?
We understand the concept. Yeah, a thin market. I think you call it thin.
Yeah, so when the market is really thin, a small number of coins are changing hands, so the price is not indicative of the equilibrium status, right?
Right.
It's a bad thing because it can correct back down and surprise a lot of people.
But in a way, this is like a moving average, right? Because you have so many of these coins. 70% of the coins have not moved in a year, right? So if we look back a year, Bitcoin was trading at 30,000, right? So 70% of the coins are going to get this price of 30,000, and then there's going to be a little bit of coins that have the price of 67,000, right? Very few, So
Exactly.
you're basically sort of taking a weighted average of these coins that haven't moved in a year versus the newer coins that have moved.
Yes.
And I think, I would also say that for these ETFs, there's this concept of the price at the end of the day. They don't just take the last price; they take a weighted average of the prices during the day as well. So it's not a crazy idea to use these things. So that's the realized, the RV in MVRV, right?
Absolutely. And the other thing I will add is the realized cap or realized market value is essentially a great measure of the real dollars that have moved into the market. So
Right.
that's a very useful value. Now, market value is generally, like I said, higher than the realized value, but
Right.
by what portion? If the gap is too wide, you should get worried, right? If the gap is narrow, it's very nice. It means the price is probably going to stay there.
Right.
And the people take the ratio of these two. The ratio is generally higher than 1. Right now it's around 2.5. 3 gets me a little bit concerned, but at the top of the previous cycles, we've gone up to 4, 5, 6 range. And that
Okay.
means, for example, at 6 means market cap is 6 times the real amount of dollars that have entered the market. So you really have a bubble at that point, right?
Well, another interesting way to look at that, and I'm very kind of into this whole power law thing, right? So if you look at sort of a deviation, a normal deviation is, double kind of the trend line in a power law. That's sort of one standard deviation. So if your normal realized market value is that ratio is 2, right? And if you're 2 standard deviations above it, right, then you're going to be in that kind of 6-ish kind of, range. So those are sort of equivalent. You're sort of seeing sort of two signs of the same phenomena, right? And I bet you if you look at your charts, you're going to see that, and I know it because I looked at your charts, but like 2017, in November, December, I bet you that we're going to be seeing those 5-6 ratios as well as in 2020, right? And so I guess what you're about to tell us is, at what point do we kind of say, hey, we might be a little hot?
Yeah. So essentially, if you take the power law predictions, the deviation from that probably gives you the average. The deviation from that will be reflected into MVRV going higher or lower, right? So that's kind of a short-term or mid-term reaction to it. Okay, so what we're trying to do here is first of all, when you look at the chart, MVRV correlates very nicely with the tops, cycle tops. Okay, so then my question was, can we analyze this statistically and gain some insights from it?
Right.
To kind of come up with a rule of thumb in deciding, measuring the risk of the market. Okay, so here's what I did. I have a large regression model. It has a lot of things in it. It's a multiple regression where I include some of the time trends and some of the previous price effects to take care of momentum. I'm also including a few other on-chain metrics. The reason I do these things is when you only have one variable, you have that problem that we discussed previously with ETFs. That single variable might be capturing the effect of anything else that it correlates with, right? But when you add more and more variables that are theoretically sound and they're supposed to be predictive, you're not just throwing in new variables. If you do that, then you get closer to the pure effect of that single metric. Okay. So here I'm interested in zeroing into the pure effect of MVRV. And on the left, you see it's not as good of a fit as we saw previously, but it kind of does some prediction. Seems to be correlating with price, especially at the tails, at the ends.
Okay.
What's our score? It's too small. It's 23 or something. That's still good. The data I analyze from businesses or maybe social networks and such, I'd be happy if I get 10% R score.
Okay.
So, again, I'm happy with. And then here I'm running some extra analysis to extract the relationship between MVRV and the price change. And importantly, here I'm moving the price 30 days into the future. So essentially, I'm taking today's MVRV value to see what kind of price does it imply 30 days from now. So it's kind of a crystal ball approximation, or whatever you want to call it, right? So we're predicting the future. Okay. Now, the model tells me, if you look at the association, when MVRV is sort of at 1.5 all the way to 3, nothing really happens. It has no indication, no meaning. It's probably like where we are. We are now at 2.5. Market can go up, can go down. It's not meaningful.
It's sort of irrelevant at this point.
Exactly. It doesn't necessarily mean it's going to go up or down. But numbers above 3 are not sustainable. And as it goes above 4 and even more, it indicates that balance of probabilities tilt toward a crash. So essentially, you're not going to think, we're thinking in probabilities here, okay? You're not going to get a perfect prediction, but the probability of a crash increases a lot. You can see at 4.5, the average behavior has been more than 50% crash. Okay.
And when you say crash, what does crash mean to you?
30 days later, price was 50% lower.
Okay, that's a crash.
That's a crash.
Okay.
And then if MVRV is less than 1, you see that it implies at 1, it probably implies 15%. And less than 1, 80.8, I think, was the lowest it got. That implies a significant 20-30% rise in the next couple of in the next month. And when you look at the chart, you can see it doesn't actually remain a long time under 1. It's in the extreme panic phases of the market that you see this, like after the COVID crash or things like that. Whenever that happens.
What's interesting is it's much more predictive on the downside for crashes than it is for rallies, right? So, you're sitting there going, it's cheap, but you still might be waiting another year, and it might be like all of 2022. And a lot of, there were people in 2022 who was like, this is over. Fed's going to cut, we're done. And then it's like, nope, there's Celsius. Nope, there's Sam Bankman-Fried. Nope, it's going lower, But,
so someone's asking about, can I use this to get out of the market? Like I said, I don't intend this for, short-term trading. That's not what I do. But the way to interpret this data is, yes, if MVRV is bigger than 3.5, the risk of market crash is high. It doesn't mean it's going to crash. Maybe you will sell and it actually goes higher, right? But then it will crash again, right?
So how would you use this data? Like let's say you fundamentally believe this, and now we chug along, and all of a sudden we find ourselves at 4 ratio, right? What do you do? Do you lighten up with your Bitcoin? Do you use this to sort of delay any new additions into the market? How do you use it, or do you do nothing, just hodl through it? How would you apply this personally?
Listen, I'm much more interested in the hodling approach, because like I said, I do this all day. I know the limitations of data analysis, not like the other guy that we know. I'm not gonna pretend that this is gonna always work.
Right.
and predict the market, right? So this is based on the data we have. It's based on the past. There's no guarantee that it will continue.
Right.
Although the beauty of this analysis is that it has a logical interpretation, right? The market
Right.
value can't be too separate from the real dollars, right? So that gives me some more confidence. For myself, I mostly do dollar cost averaging. I've been never sold any Bitcoin, but I have hedged a little bit through the options when the market is very risky. I think of this as risk. When MVRV is higher, I sort of, if I'm doing DCA, I probably slow down.
So again, so this would be as far as somebody maybe coming into the market and maybe they slow down their purchases because all of a sudden maybe they can just hold the money and they'll buy it in some new money later. But I think neither you or I are advocating to people that they become kind of flash traders and
But it's good to understand. Right now, there is risk in the market. If there's a crash, I'm not going to get concerned. That's exactly what I expect, right? But I wouldn't be so overconfident in myself to say that I can predict the market. You get out, Bitcoin goes higher. You ape in, Bitcoin goes down. It always surprises you. One of the things I've always told people is Bitcoin punishes tourists. If you're just in and out of the market, you will end up losing a lot more than somebody who did nothing.
Well, I also think it's psychological, right? Because, I always tell people there's so many people who look at Bitcoin and they're like, well, I'm going to sell and I'm going to buy back cheaper. And I just, I've been around the block enough to know that never works. Because what happens is usually they're right and it does go down further. And then their confirmation bias starts changing and they're like, oh, I was right. Oh, yeah, I'm glad I didn't. Yeah, I'm glad I sold. I'm glad, And then all of a sudden, 2 months later, 3 months later, in one day or in a couple days, it's back above their price. And then now they can't ever rationalize buying this. So what I tell people a lot is, if you think you're going to sell and buy back, you're probably wrong. Now, if you need the money and you need the money, you need the money. If you have a medical emergency or you need or other things, you just need it, right? Go spend the money, spend the Bitcoin, right? But the idea that you can time Bitcoin, I think I at least and Bitcoin always saying time in the market, not timing the market. I think timing the market is, and I've traded a lot of stuff, in the past. And Bitcoin is the one thing I would just really advise people not trading personally.
The consequences of, like you said, you can sell at the right time, but the consequences of missing a pump that could be as big as 20%, is unacceptable to me. Right.
Well, and especially we're dealing with this asset, which is, I think you and I both agree that it has really enormous sort of long-term potential. I fundamentally think it's not a question of if we're getting to 1 million, it's when we're getting to 1 million. You know what I mean? We're going to get there, I think, and the question is whether you actually are in the market when it hits 1 million, but like this asset has gone from a price of 10 cents to almost 100,000, in 15 years. And it's done this pretty regularly on a power law. There's volatility, but there's no reason that we think that this thing is going to slow down this, the next 2 years, 3 years, 5 years. So I think it's, to be able to weather the storm here, you really do need, it's great to have all this data. I love having all this data. I'm super pro data, but I also think you have to realize that, fine tuning it is not the goal here is just being in the market, right?
I'll give you an example. At 15,000 or 16,000, I'm not gonna lie, it was painful, right? And you think, market has dropped from 69 to 15,000. You're thinking to yourself, what if, well, it's gone so far. What if it goes to 5K? What if it goes to 12K, right? So then you think, should I buy? Should I not buy? I kind of used this metric at that point, and I saw it's below 1 to just give myself more confidence. And I kept buying and I kept buying.
Yeah.
Anything in those times, my bank account was empty. Like anytime money comes in, it's into Bitcoin. And that gave me, like, looking at some of the metrics, gave me some more confidence. But you can still do pretty well by not knowing any of this thing and just setting up a DCA for yourself. So
yeah, whatever works for you, whatever works. But it's all about temperament and, and not panicking. I think that's a great thing. Okay, let's continue the slides. So those are this MVRV, very interesting. I think we'll be following your tweets, and I'm sure you're going to inform us when we get to kind of critical levels.
So what we can do here is, this is one metric that works well. I'm now looking at futures market too. Something that is beautifully helpful is the funding rate. And if you follow someone called Jason Shapiro, he's not a Bitcoin guy, he's just trades market, and he uses a lot of the CME data to predict extreme positioning. We can use funding rate to predict overly bullish or overly bearish positioning, and that can also be something else. I'm looking to add a few of similar metrics and kind of build a larger model that will help us gauge the risk in the market better. And
I can tell you one thing. One thing I have been looking at recently is the interest rates on Aave. Do you know Aave, the platform? So it's it's a borrowing platform on crypto. And when I was looking at these rates about 6-7 months ago, and you could borrow for like 5-6%, right? And now it's more like 15%. Okay. So, so a lot of the people are really, they're trying to borrow, right? They want leverage, and they're willing to pay a lot for that leverage, right?
Yes. And that is initially good because that means a lot of retail is coming in, but it gets us into the bubble. And if it gets to the extreme level, then the inflow of degens stops and then the bubble breaks. So that's,
I remember at one point it was up to 40% on Tether in 2017. It was 40%. I remember it. It was like on Binance, they were charging, or Bitfinex, was charging 40% on Tether.
Yeah, 70%.
70, yeah, okay, well.
It's just people, just lose their mind,
Well, they think I'm only in it for a month, so what do I care? That's all 6% a month.
There is 100. People take 100x leverage. It's just they want to get rich tomorrow. That's how impatient these people are. And just, if you have a gauge of how many of these are actually active in the market, that's a very good predictor. Whenever they are, long, you should not be long. I mean,
another thing here is, I'll just sort of segue. There's a lot of people who are like, come to me and they're like, Fred, you're very bullish on Bitcoin, but I'm too poor to make money in Bitcoin. And I'm like, what do you mean? And they're like, well, I don't have a lot of money. And so what I need to do is I need to like go into these extreme meme coins, altcoins. And I think this is the craziest logic that I've ever seen, which is I don't have a lot of money, so I need to take even more risk, which
is that reminds me of these what is it, the tickets that you buy and you win,
like a lottery
ticket. Yeah, so it's like, I'm already dead. What's the worst thing that can happen? I'll either get rich next month or nothing, right?
Yeah.
And this works crazy. Like in many other countries out of the US, people don't necessarily don't have a lot of money, right? And then the market of all these crap coins is doing very well. People, pay good money to learn tradings and to draw lines on the chart and predict the market, and also buy a lot of those.
Well, the government makes a lot of money on them. The state of California makes a lot of money in the California lottery. So, they've got a little bit of a monopoly in some of this stuff, so they don't really want to give up a share of that to Binance or somebody. So, all right, let's keep on moving. So, the next slide, you have 3 more slides, right?
This should wrap it up. Yes.
Oh, okay.
So
Cool.
this wraps
Great.
it up, but I have 2 more slides.
Okay, great.
To you.
Good.
Okay, so what is this? I have, well, first of all, let me show my work. If you want to talk to us, my company, just contact at 21st, email contact at 21st
Right.
Capital. We do consulting. That's all I'm going to say. Then one question I had about the power law was whether we are overfitting, which I kind of knew we're not because it's only one variable of time. But one of the typical pitfalls of data analysis is when you have a model that works very well on your data, but it fits by chance. Why? For example, if you put in a ton of variables in a model, you're going to have a very high R score anyways. Why? Because every one of those variables have some noise in it, and the noise happens to correlate with your outcome one way or another. And if you have too many variables, it will end up giving you a good fit. But you will be burnt when you collect data the next day and you apply the same model and you see, oh, it doesn't fit because your model was only able to predict the past and nothing in future works because you really didn't have any model. It was just chance.
Right.
So one way to get around that is to not use all of your data for modeling. Sometimes you can use half of the data for modeling and then leave the rest for testing.
Then you have the out of sample
exactly.
testing. Yeah.
So some people call it out of bag prediction or training and test sampling. This is a lot of the stuff we do in machine learning, right? Because machine learning can overfit very well, but we prevent that through this thing. Sometimes also called cross validation. So what I did was I kind of put the power law model to test.
Oh wow!
What I did was I used relatively kind of roughly half of the data, and then build the model. The log model and predicted the rest. And then I also did the second half, used that as the training, and then predicted the past,
Oh, okay. Yeah. All right.
So the question is, if the model that is built on the first half of the data is also able to predict next several years into the future, then it has a lot more validity and predictive cross-validation. Yes, Josh is correct. All right, so I did that, and this is the result. Blue is obviously the price. The red line is, first of all, the yellow is the full model. Essentially, I'm using all the data here, and that's the prediction. It's turned back into the non-log model just to see how much deviation we are expecting.
Right.
Now, the red model is one that is I have trained based on the first 3,000 days, which is 2 cycles back.
Right.
That model, first of all, it's very close to the original model, and it predicts very well. 3 years later, I'm very surprised. And then the green one is one where I use the second part of the data and then fit it to the past. Same thing. So if you look at the log version, you see the green one is a little bit bad in the early days, but let me remind myself which one was which. Red was okay. The red line and the yellow line. Essentially, if you use half of your data, it predicts. It keeps predicting very well 3 years later.
Yeah, I both of Giovanni and my friend Stephen Perrineau, both astrophysicists, right? And they both have kind of come to the same kind of conclusion. So Stephen looked at how does the power law variable, change with time. And so he noticed that it was actually up to 6, then it dropped down to like about 5.2, and then it rose back up to like 5.5, and it's sort of stabilizing now, right? And so, and also Giovanni did other studies like that, and he noticed that things were again stabilizing, right? So actually, there was more of a earlier variation, and then we're stabilizing. Also, the other variable thing I would say, the standard deviation started at, over the entire series and log thing is 0.3, but it's now decreasing to about 0.25. So it definitely looks like actually the model is converging more than diverging right now, so
Although converging in a log.
converging a log way.
Yeah.
But I was explaining this to somebody today actually, and they were saying, how do you square this with like this so volatile, this asset? And I go, well, it is, but not in log terms, right?
Yeah, look at it. Like in the real terms, it actually get more volatile. You get more deviation, but in the log term, it's compressing.
Right. And then he's like, well, we don't live in log world. And I said, well, Bitcoin does live in log world, right? So, you may not think of it in log world, but it is a log asset, right? That's kind of the correct way to look at this thing. And I know people don't want to look at it. They want to look at it in this way, but you really get something out of actually looking at it in log space. And, it also tells you that, how many other assets do you know that have a potential to go up 64 times in the next 15 years? I don't know any, right? Now, I'm not saying for sure it's going to, but if we are at a power 6 log and, we've had 15 years of data and the next 15 years, we would expect it to go up 64 times due to the power 6, right? So it's very somewhat counterintuitive, these things, because we humans are not really great at thinking in terms of log space. We just don't think that way. And so, I would just say that this throws a wrench on kind of conventional thing and conventional financial thinking too, right? Because, we're very used to, well, I'll get 3% here, I'll get 4% here, I'll lose 2%, I'll make 5%, That's how we think of our financial future. Not, well, let's see, I'm going to make 10 times my money in the next 10 years. And maybe if I keep it for 20 years, I'll make 30 times my money, after tax and after inflation. And Bitcoin does appear to be that kind of animal, right? It, unless something fundamentally changes with what's happening, that's what we have to look forward to, I think. Now, it could change. Something could happen, but that does appear statistically to be the pattern right now.
Yeah, the way to think about it is this gives you the expectation or the average, right?
Yeah.
We could be higher or lower, but it tends to come back to the average. Of course, again, not guaranteed. I think I refer you to your fundamental thesis to see if that makes sense, and particularly because Giovanni found.
So I'm going to ask you a question. Why do you think Bitcoin is so successful? What if just ignoring all the stats, just you own Bitcoin? Why do you think it's just done so well, and why do you think it's going to continue to do so well? What's the 3-sentence version of why it's so great?
It is money that's 100x better than gold.
Okay.
It has a fixed supply. Nothing in this world has a fixed supply, and it's benefiting from the network effects. 2 people adopting it becomes 4 becomes 8, and it keeps on growing rapidly. Mm-hmm. And it is kind of it's the best money on all aspects. It is divisible. It's super easy to move. It's super easy to validate. You just need to run a software. Transactions are easier to make than gold or even fiat. In fiat, we think it's easy, but we pay. If you use your credit card, there's a 3% charge on it. So it kind of the costs are hidden, but it's still there, even though lots of centralization was supposed to decrease the cost of it for the consumer.
And I think the one other thing I'd like to add to that, it's easy to store and it's easy to secure, right? And you can be in any country. You can be in the middle of Turkey or Lebanon or Argentina or China or Ukraine or Russia. You can walk around with your Bitcoin on you, and it's, and that's just a remarkable thing, I think.
once I created a video about the history of money, and you can see, people moving on from kettles to, different kinds of metal coins, and then silver and gold coins. And you see after every change, the people who kind of were too slow to jump ship and adopt the new technology, they were left behind. We have this opportunity now to observe monetization of the best money that humanity has ever created. We better not miss this opportunity, and I think we should think of ourselves as being extremely lucky to be able to, see this firsthand and participate in it.
And just to also say, in order to participate, you do need to buy Bitcoin. So again, whether you're DCAing it, whether you're doing whatever you're doing with it, you actually need to get involved. And so I would encourage everybody to get on the train. It's not so important where you get on the train, even if you get on early and you get on in 2021, not the end of the world, right? Time fixes everything, but you got to get on, because if you walk by the gym, you're not going to get in shape. You got to go into the gym. You got to use the machines. So I would encourage everybody to kind of actually get a Bitcoin wallet and learn about Bitcoin. And, you don't get this stuff just by watching videos like this. You do have to own it, and you have to care, because if you don't care, it doesn't matter. You're going to forget about it. Something new is going to come up and you're going to be like, maybe I should buy this AI fund or something. And I'm not saying you shouldn't, but if you want to understand Bitcoin, you got to get in Bitcoin. So, and I think it's, by all indications, we're in a pretty good period. We got this ETF. We got very good 3 months of this ETF. We're probably going to have more. We have a halvening. Last question. Halvening, does it make a difference? Everybody wants to know.
First of all, I love having, but I'm biased.
Okay.
The effect. Well, you are right that it doesn't have an immediate effect. The data doesn't show it, and a lot of people sort of then come out and say, "Oh, it's all priced in, and it doesn't matter." But if you just kind of shift the chart, somewhere like 6-7 months after,
then it seems so. Yeah,
the cycle starts. So, and there is a story that explains this, and this is, when halving happens, it's basically like a natural seller is cut in half, right? And it's put the other way, it's like a new buyer has entered the market and buying some coins every day. You don't, and that's not a huge amount, and as we go, it's going to be a smaller amount. If the price goes up, not going to be that small, but it is possible that the effect weakens a little bit after every halving, right? Because it's exponentially going down. But we expect the effect to appear after a while, because there is still coins, available for sale. If that new buyer that the halving brought keeps buying every day, day after day, there is for some time we don't see the effect. But when the inventory of coins on the exchanges goes down, then you see people facing shortage. Shortage means prices going up. The Bitcoin CEO raises the prices to deal with shortage. So that's how I explain this to myself. Why is it that it takes several months after the halving to see the effect?
Well, and also the other thing to that effect is this. Once the halving is done, then the miners are not, and let's say the price just sort of jumps for other reasons, right? It doubles, it triples, like it did in 2021, right? Well, you don't have all these miners. They don't have so much inventory that they can just start dumping on you like they were doing 3 months ago, 4 months ago. They're going to think twice now about dumping all that inventory. They have half as much per day to sell. And now they're like, maybe I shouldn't sell it quite yet. Maybe I should hold on to some of it. So I definitely think it makes a difference in terms of, allowing for these kind of moves up to happen. And, with these ETFs, you have this, you know, exogenous thing that could move the market up. And it's not so much that there's so much selling that's happening now, but I would be worried if the miners had too much Bitcoin and then the Bitcoin price quadruples and they're like, bam, we're selling, you know?
You know,
I don't know.
one way to think about this is in layers. There is the general layer of, imagine an ocean, and the level of water is rising. There is this background rise because of the power law-like behavior, which is coming from adoption, right? So that's there. But on top of this beautiful slow rise, you have a lot of volatility, which sometimes masks the rise, sometimes leads to crashes, and sometimes leads to explosions. Those are like we can call the bubbles or cycles, right? Those could be triggered by a psychological, you know, there's a case to say that halving is mostly psychological after we've done several halvings. The effect is really going to be small, but still, you know, a little bit of psychological push can bring in a new people into the market who think, okay, the price just jumped. Maybe I should take some leverage and take a position that makes the price go up even higher. And then that turns into a positive cycle, self-reinforcing cycle, but that can't go on forever. At some point, the leverage degen money ends, and then you come back down. So that's why you have this beautiful flow, a beautiful trend line, but on top of it, you get this crazy up and down. So you can say the halving causes these, but doesn't necessarily change the general trend.
Well, Sina, thank you very much. It's been a fascinating discovery, and thank you for putting these slides together. I think it really helps keep the discussion really focused, and I think we'll look at it. We had a lot of people watch this thing. We're up to 3,500 people now watching right now. So I think we're going to have, once all said and done, we're going to have 10 or 15 or 20,000 people look at this video. So thank you very much. And we'll catch you online. And again, your Twitter is a must follow. And thank you very much for being here. Thanks, Sina.
Thank you very much for inviting me. And I love this format.
Thanks. Bye.